Good evening. Good evening. Welcome out, everybody, to the Trading Foundations course. We are going to give it. I started early today. Amazing. Like a pre Christmas miracle. I mean, it was only a minute early, but still, Hi, Perry. Good to see you. Hi, Jeff. Great to have you. I hope all is well for everybody. I know there's some people coming in, trying to get in. I'm excited for today. This is an interesting one. I wasn't exactly sure the best way to tackle this, but I thought, you know what? I think I could use this to leverage going into our options foundations course. Hi, Bob. Good to see you. Which will start next week. So this is our last formal session. On Thursday, we're having just a Q&A, just like a broad, bring any question you can think of. It's just going to be straight Q&A. If it lasts 5 minutes, it lasts 5. If it lasts 40, it lasts 40, whatever people bring. So I'll make sure everyone knows. And then on next Tuesday, we start options. So what I'm going to do is I'm going to take these case studies, since they're good representations of what we would be looking for. You're going to see I tried to include both market context as well as then the stages of these case study traits. So we've got one bull to look at and we've got one bear to look at. So we're going to look at one version of each. We're going to look at the underlying conditions as they stand on our historical record from our market posture. And then we're going to go through the slides. We're going to talk about anticipating a signal versus waiting for confirmation. When would I? When wouldn't I? What did I do? Then we're going to look at a thought process for managing the trade, as far as what are some things that we can be thinking about letting winners run. We are going to reference the stages of a trade. So if you're thinking stages of a trade, that doesn't sound familiar, Scott, go into the content library, scan through until you find the session on stages of a trade, and then you'll be able to go through and you'll see that's the way I've positioned these slides, these visual, these charts taken from these various stages and giving us the representation of what does it look like. So that's what we're going to be doing. So what I'm going to do then is I'm going to take these same case studies, and when we talk about calls or puts, I have the ability, using the options model within my platform, to go back in time and construct and say, okay, what would happen if we bought a call? Which one would we buy and what would it turn out to be, versus why would we do that instead of this? And we can see how the trades would have turned out. What would profit be? We can take these case studies and we can say, now what would have happened if I would have done it with a bull call spread instead of a call? And we can go through. So I am going to reference back to this recording from the Options Foundations course that starts next week and say, remember, right? You can go into these case studies of trades by clicking on this recording. All right, let's dive in. Welcome out, everyone, formally to the Market Watch Group Trading Foundations course. This is the case studies session. This is new. I'm excited for this. I've always wanted to go through and sort of do something like this. Like I said, I feel like it's a great opportunity to lay the groundwork to segue into understanding how would we take different types of trades under the same circumstance. So we're going to build on our case studies with these. My name is Scott. Let's get going. Here are the disclaimers. As always, remember, these are found in your email if you ever want to read through them in great detail. Here is our agenda for today. This is a simple one. I want you to ask questions. I want you to be like, well, wait, challenge it. Why this? Why not that? What if you would have seen this instead, right? Really think about trades that you've built and taken on your own that were in a similar type of a circumstance, and see if it might lead you to a question. Because remember, this is not a let's look backwards and be like, look, this is how great it can turn out. No. We want to look backwards and say, this is what we would expect to see in these various stages of a trade and what led to it. Bullish case study first. What are we going to evaluate? We're going to look at what the market posture was. Bob says, I'm taking them back to grad school when they used case studies back many moons ago. We're going to look at the market posture. Then we're going to go through the 4 stages. Pre-trade. What would a setup have looked like within the context of that specific market posture? We're going to look at after receiving a trigger, whether it was a anticipatory signal or a confirmed signal. When we get the trigger, then we are in the next stage, and we will look at the momentum stage and, what are we looking for? What charts can we use? And we're going to look at nearing completion. We're going to talk about what would be the thought processes along the way. And like I said, getting a sense of these is going to be helpful as we build into how would we translate these into options trades. Whoops, I missed my slide. I copied and pasted and forgot to change it to bearish. That second one is bearish trade case study. So we're going to do a bearish trade case study, same exact stuff. What was the posture? What would the setup look like? I'll even talk a little bit about, what the underlying characteristics of the stock might be. Waiting to develop the momentum, and then finally the nearing completion. And when we're done and we get to the Q&A, we had a great conversation today. If you missed it, pop on and go read through it on Discord. Great conversation today. I unfortunately wasn't able to participate until later in the day to put some comments in, but talking about specific trades coming from our watch list and what are they looking for a setup and what strike price, and really very interesting collaboration as well. Sandy asked a question about the application of Kelly criterion. I responded back. Hopefully she saw, she's here. Hopefully you saw, Sandy, that we are going to answer that question. That's exactly the kind of thing that you should bring with you to these sessions. When I say Q&A, remember, we start with the content we cover, and then we open the door. What any trading question is valid. That's your time. Lightning round. Let's get the questions on the table. So if there's anything you've been waiting for, definitely get ready for it. Let's dive in to these case studies. So first and foremost, what was my market posture? Let me get my drawing tools ready because we're going to just kind of play through this a little bit. And you can see I moved this over so that this looks like this was live. So where are we here? Well, we're back in late May. Third week of May. What was going on? Well, we had been bullish, and we had a little bit of a drop, 2.5, 2.75, and then we dropped just a little bit. We got hit just a little bit. Now, you've seen what it can look like when we drop from a 4.25 into a negative territory. So this right here, you now realize, and that's partially what you have to do with this process is just understand that you're laying context. You're just understanding what does it look like when I see a market and I score it, and then what happens. So here, when we saw 2.75 to 1.5, certainly we were concerned. We were like, oh, it wasn't an enormous drop, but it was 1.25, and we said, that's not great. But then the next week, now remember, we were still at the bullish end of neutral here. And then we stayed at the bullish end of neutral, and we actually improved a quarter of a point. So our concern on this April 30th to May 7th drop dissipated. Now, some of you may remember this period of time because what happened right around, I believe it was May 8th, coming out of this, what happened? We got a debt ceiling deal. There was conversation of, oh, there may be a government shutdown, and we thought it was going to carry through to the end of the week when the deadline, but they got it done early. And then all of a sudden, what happened? The next week, bam, another increase. So at this point, what are we thinking? I've moved out of neutral back into the beginning parts of bullish territory at a 2.5. Is it extremely strong? No, but it's coming from a previous period of strength that never really got too damaged. So I feel pretty comfortable assuming that I'm back in this. It's not 4s or 5s yet, but it's 2.5. Now, remember, it does get to 4s or 5, but at this point, we haven't gotten there yet. Things are just really starting to come into their own again. Okay, that's the context. So what would we be thinking? I would be thinking I am definitely bullish. I'm looking for a bullish amount of trades, but not a very bullish, right? So more than a couple, but less than a lot, somewhere in there. And you're like, that's not a number, Scott. It is, I promise. More than a couple, less than a lot. So somewhere in that few, I'm going to have a few more. Our sector rotation, you'll notice here, improved. What does that mean? It means that there were more sectors showing us strength. It was broader. We know that if our sector score is 0.5, 0.75 increasing, it's broad. So we should have a good number of candidates on our watch list already at this point. Everything was positive, right? There were slowdowns, but never negativity at this point, right? We had a pretty decent March and April, then a little pause, and then we're thinking, all right, so that's the context. What am I looking for? Bullish trades. Where am I looking for them? Probably in technology, communication services, consumer discretionary. Those were our big three. At that point, we hadn't seen financials or industrials yet. If we had, our score would be 0.75. They weren't there yet, right? They had just, in fact, we probably at this point really is where we got a consumer discretionary back in place. And that's what caused my score to rise. And I want you to notice how nice it is to be able to go back and look at my scoring here and be able to explain the market without even having looked. I mean, of course, I've looked at the market, but I know based on my scoring what's going on with these numbers, right? I know what I see that would cause these things to happen, so we can have a pretty good idea of what was the context leading up to the trade. Stage one, pre-trade. So what are we looking for? I'm looking for stocks that are uptrending, meaning, and it doesn't have to be for a long period of time, but something that just recently broke to a new high. You can see this one did. Something that is on a consolidation. You can see this one is. I would like the volume to be average or less, not above average. And you can see that it's about average. It's maybe a titch above, but not 5%, which would cause it to be scored negatively. So this is where I'm saying I have a setup. What am I looking for? And I want you to notice the correlation as to what we're seeing right now. We have some stocks that are moving into this consolidative pattern. All of a sudden, it's pullback. What are we looking for? We're looking for the sellers to stop and the buyers to start coming in. That creates a support level. That's literally the definition of support. So we're looking for this to give us the completed setup where it's at support, followed by the trigger, which is bouncing off of support. Now, what am I going to be looking for? I'm going to be looking for a candle. I'm going to be looking for my stochastics. Look at that stochastics. How many do we have that look like this right now? What are we looking for? A turn. So here's the first question. Am I willing to anticipate? I told you right now, in the current environment, we're a 4.25. We've increased 4 weeks in a row. Yes, absolutely I am. Not like maybe I am, but absolutely I am. Back here, I had just come out of a little bit of a shakeup. I had a pretty good market before and it was coming back in. Would I anticipate? Yes, maybe. Not like, oh yeah, for sure I will, but maybe, which means maybe we would anticipate, maybe we would say, you know what, I need more confirmation. This is going to be a little bit more discretionary as far as whether you're willing to jump into the trade based on price, right? Maybe you like the candle, but you don't have the stochastics yet. Okay, so let's go. What happens next? So this is waiting to develop, anticipatory. If we moved into the waiting to develop stage, that means we got a trigger. Now, I want you to pay, well, I'm gonna do something here if I can. And I'm gonna just color something out here. There. That's what it looked like. That's better. Okay. Now, this is the chart. You might not have noticed what I did, and if you didn't, great. But if you look at this chart here, what do we have? All of a sudden, I have a candlestick that turned up. It's a doji, but it's definitely a stronger candle. We went from 411 to 415. We were up 1% on that day. So that is definitely a bullish hook. If price is what you're focused on, that would be an anticipatory trigger. What do we not have yet? We don't have stochastics yet. So if you are willing to anticipate, you might look at this and say, this is where I'm taking the trade now. I'm in, let me change the color. I'm in up here, my stop somewhere underneath here. What am I looking for? I'm really looking for something like this. That's what I'm hoping for. Something that moves like this. You can see, some of them happened even faster than that. Some of them, we have a couple like this. Some of them aren't as big. That wasn't as big. That wasn't as big. So we're hoping for one of these big ones that gets us up into this area up here, right up near 430, 435, something like that. We don't know yet, but we're starting to think about that, right? We're starting to think about that. This would be an anticipatory trade. What happens if I wait for confirmation? It looks like this. I might lose. You can see that could be now. Hopefully, if you were waiting for confirmation, you were looking for that confirmation early in the day. And hopefully, if you were waiting for that confirmation, you were able to pick this up at least in the first half. But these are the considerations you're going to see. Now, of course, we have confirmation down here. Of course we do. Look at that. Looks great. Can we look at a longer timeline to see how high it reached in the past for this? Normally, yes. On my slides, no, because these are pictures I took from, right, in order to go through this presentation. But you could go back in time to see where have we been. We had definitely been above this, up around 450 prior. So actually, had we? Now I'm trying to remember if we had or not. But yes, and that's a great idea. Jenny is to say, well, where has this thing been in the past? Is there resistance? Now, if there's not, that shouldn't dissuade you. If there's no resistance, that means we have blue skies. That's a good thing, right? But now we have this confirmation. So now what? This is where we would be in the trade. Anywhere, I'm gonna delete these and start over. Anywhere in this zone is where we should be in this trade, with an initial stop under here, target somewhere up here. That's what we're thinking about. Bob says high was 480 in January of 22. Thank you, Bob. Sorry for the basic question. What does solid red mean versus a non-one? Not a basic question at all. Candlestick construction. A white body means that the open was at the low of the body, the close at the high. White bodies or the unfilled are bullish candles. Whereas when it's filled in, it flips it. And it means that the open is at the top of the body and the bottom is and the close is at the bottom, which means red candles are negative days. They're downward days. So upward progression versus downward progression. Remember that in technical analysis in this course, we do talk a little bit about candlestick construction. Great thing to go look at. Excellent question. Okay. Now what? So now we kind of have a sense, right? This is, we look at this and think this is the trade, but now what? Well, now that we wait for develop, what are we waiting to develop? We're waiting for momentum. So let's keep advancing this and see where that takes us. Now, momentum, you'll notice, actually came This is the same day. I'm going to go back. These are the same days right here. So when we got this confirmation date, we actually also got confirmation of momentum, which means what? Which means I have the ability to move my stops pretty quickly. So if I started with a stop down here, I'll be able to, after the first day, move my stop to here. So I take my risk from 409 to 414. I take $5 of risk out of the trade. I might only have had 8 or 9 to begin with. That might be half my risk out of the trade. That's what the momentum stage gives us the ability to do. It's now moving the right way. We think it looks like this or like this. It's that first candle coming out, right? One of these back here that starts this move. Okay. Fantastic. We move our stop. Aggressively? No. We don't need to be aggressive. We move our stop and we let it sit. Right? Now what? Now we advance it again. And you can see that, we got this signal here and then it moved. And for the next couple of days, it sort of pauses a little bit. And this can have you spooked. We don't want to get spooked. Remember that at this point, if it's in the momentum stage, that means that it's going right. You got in somewhere around here, and now it's up here. You're making money. What emotion do I want to feel when I'm making money? Hope. Hope. I hope my good trade turns into a great trade. Bob said happy. Hope. What is a common emotion when our psychology is wrong? Fear. Fear. Fear causes you to cut your winners short and let your losers run. I don't want to feel fear. I don't want to be like, oh, if I don't do, look, it's right. What do? We can ease the trade. We take some risk out by tightening our stop. Is it at a place where I would take profit? No. When the market posture was at a 1, a 0, I was like, hey, 2 or 3 days, I'm taking profit. Bam, half of it. Here, I'm waiting for 4 or 5 days still. And I'm only going to take maybe a third or a quarter of it because it's better. Remember that, right? It's better. Okay, so now what? Now we stay in the trade, hopefully, and then all of a sudden, what do we end up with? Well, look at what the Heikin Ashi candles can do, right? And I know I kind of skipped. I was like, I'm going to end up with 50 charts on here if I'm not careful. So remember, we entered back here. We got a little hung up for a minute right there. And then what? And then it pops for a couple of days and then it gets hung up and then it pops for 5 more days. So yes, what's going to happen? Well, am I going to take some off the table? Probably right there. I absolutely will. How much? Like I said, a third or a quarter. We take that off right here. And what do? We move our stop and we hope it breaks out. And it did. And it gives us a little more and a little bit more. I said 435. So when it gets to 435, could I take another third off and say, let's get a little bit more? Because at this point, it's done what we asked, but there could still be a little bit more, and we could end up tightening our stop and letting the stop pick us off right up here. You'll notice that the stochastic rolls over, the candle turns red. We get stopped out around 437-ish, we'll call it. That's our trade, right? Did we get in at the very bottom? No, we didn't get in down here. We didn't have any expectation. We said once we get some confirmation somewhere around 415, I'd say around 414 to 416, somewhere in there, that should be it. That's a nice 20 point move, a 5% move in a period of about 12 days. Okay, now what? That's the trade. Then what do we do? Well, now it's the middle of June. What was my market posture in the middle of June? Still bullish. So at the end of this, my horse just ran the race and it won. What am I going to do? I'm going to feed it, rest it, and I'm going to look for this pattern here to repeat itself over here. Bing, pop, and do it again. And I'm going to do it again until what? Well, until our posture drops, which wasn't until the end of July, early August. So this is the middle of June when this trade finished. Yeah, we got 2 more big windows of trading. Our posture by this point was now a 4, a 5. So what did we do? We looked to do this again. Why is this important? Because right now, where we are in the market looks just like this. It looks just like it. We're seeing these same types of things where this breakout isn't like, oh, that's it. No, we got 2 more like it after that. And that's what we're kind of looking at right now. And we're looking at this start of a consolidation period. So what are some things we need to think about? When to relieve pressure and how much? Where do we get that? Context. Context from the market. The better the market is, give it a little bit more room before you relieve pressure and relieve a little less. If the market is a 1, a 0, if our posture is not very good, what do? We take more profit, take it sooner. That market's choppy, it's harder. We're not looking to push things. We're looking to take what we can get when we can get it. When to tighten and start to trail your stops and how close, right? When do we say, oh, look, now I've gotten 4, 5, 6 days. I'm going to take a little bit more profit, or I'm going to take the first bit of profit. Then I'm going to tighten my stop. Not that tight in the beginning. 3, 4 more days, then it's going to start to really get tighter. In fact, I might even shift from a daily chart to a 4-hour chart. If I get to day 8, 9, that's about it, right? And then at that point, whatever I get, I get. Is there a point where we just simply take profit? I said 435. Hey, if I get a move that looks like the prior moves, I'm going to take it. How much? Another third. If I take a third at the beginning when it hits a little friction, I have 2/3 left. Then if I take another third at a solid profit level, I still have a third I can let run. And if this thing goes for a run, I can stay in it. And if it runs out of legs, I'm ready to take my profits. We need to have predetermined context and strategies. What context will help you to know when do I let my winners run versus when do I? It's not always the same. And that's what a lot of people, where they make mistakes. You can't do the same thing all the time. Back to my poker analogies, just like you can't play the same game. If you're playing at your buddy's garage, with a few guys down the street, you're going to play very differently than you do at Binion's in the low limit poker room, right? And you're going to play very different there than you do in the Bellagio high limit, high stakes poker room. Now you're off strip in a low level. It's no big deal. Now you're on the strip. Now you're in a high level. You're in the high rollers, right? Context matters. It's the same game, but context matters. That's what we're getting to here. Okay. Hopefully that made sense as you looked at okay, what am I thinking? I'm thinking, how can I let it run without taking too much risk at any given time? And that's why the stages of a trade can be very helpful in guiding your thought process. What we think early, mid, and late is very, very different. If you're trying to think the same way throughout the trade, you're going to run into trouble. Let's jump to the second trade. This is bearish. I want to give you some questions, so I'm going to go a little bit time for questions. I'm going to go a little faster. What's my posture this time? This might look familiar. September 3.5. Whoops. September 4.25. September 4.25. 2.25, 1.25, 1, and all of a sudden, it's the beginning of October, and we've dropped from a 4.25 to a 1. That's 3 straight weeks. We've lost 3 points over that 3-week period. Are we bearish? No. I'm barely neutral. I'm still actually kind of at the bullish end of neutral. But has the momentum shifted to negative? I think we have to at that point say yes. Yes, that's negative momentum. Not enough negative momentum that we think it's shifted the market, the tone of the market. I like what you said. Bob said no, but we are cautious. Yes, way more cautious bullishly. And now's when I'm like, maybe I will put a bearish trade on. You're pretty aggressive if you're doing it. There's no need, right? Now, when we got to negative, I'm like, I'm about to start. Like, that was when I'm like, hey, I'm really going to start being more speculative. And then the market's like, nope, we're going to reverse. But I'm waiting. I'm not antsy to be bearish, but I'm certainly got to be able to say this is when I'm going to start adding a little bit more because I need more balance. And I still have some bullish things going on. So I better add some bearish things, maybe more than just a hedge. Okay. So that's the context. So what trade are we probably looking for here? Probably looking for a bearish trade. I'm not looking for a bull with things dropping the way that they have. Look at this. My short-term trend for the first time this week dropped to negative. So we've been breaking some support levels there. The volume was okay still. The VIX dropped to neutral. Major market analysis. The NASDAQ was already kind of on a downward. You can see right here from September 17th to October 1st, we saw the major market go 0.5 to 0.25 to 0. What does that mean? It means that the NASDAQ gave up its leadership position. That is where I'm looking to trade bearishly. The NASDAQ communication services. What led us on the way up is going to lead us on the way down. So if that was going to continue to get worse, and it did get a little worse, even still, those are the areas that I'm not looking to be like, oh, let's go find something that's been downtrending for 4 months. Something that's been downtrending for 4 months is probably defensive. It's probably starting to look good all of a sudden. That's not what we're doing. We've got to recognize that shift and what it is that we're looking for. Okay. Let me delete this. Context is set. Let's dive in. Stage 1 pre-trade. You can see, I thought I was going to be able to like mask the stock. I didn't have time. It's Netflix. Doesn't matter. What's happening? They got earnings. What happened on earnings? They were disappointing. And this thing sold off and continued to sold off. And it broke all the way down to this previous support level back here. And you can see that as it hit this previous support level here, it bounced back up. What kind of buying pressure did it bounce up on? Nothing. Remember what we say about support and resistance: recency and frequency. Recency and frequency. So you can see we hit this line 1, 2, 3 times in the last couple of months. And what's happening now? We're moving up towards that line. Great. Now, if it broke through that line, would we be thinking, you know what, are we over? Yeah, we're overbought. Not all the way overbought, but we're overbought. If this thing broke up and got back up here, would I be bearish? Nope, not at all. What would make me bearish? If it can't get through here. That's the setup of the trade. And then all of a sudden, you can see waiting to develop. Now here, this would be anticipatory. Why do I say that? Because if you notice, we're still pushing, and now the sellers are starting to come in. Not a lot. And it might look like the stochastics has turned, but actually it would look like this. It would not have turned yet. Don't let that fool you in hindsight. At the hard right edge, you don't have that. This is what I did last time. I'm gonna color it out. So it actually, nope, that's not it. It actually would have looked like that. It hasn't turned yet. Oh, I don't know why that just disappeared. Never mind. Okay. So would I anticipate this? No, I'm not bearish, right? That's why I wanted to include this on the bullish trade. I said yes. Why? Because I had a pretty good market. Would I, and even then I said maybe. I didn't say yes. I said maybe. Would I anticipate here? No, this wasn't good enough. What's good enough? Confirmation. Do I have to wait for it to get to the end of the day? No. No, I don't. I can look to try to catch this thing as it crosses. So I'm hopefully catching it around this midpoint, not all the way down at the bottom. But at this point, look at your stochastics. You've turned. Support is held. The price action is now bouncing down off of resistance. Confirmation. We're entering the trade. I would say that area is around 437, give or take. 437. Okay, makes sense? Let me know if you have any questions. Now what? Now we're waiting to see my stop. Where would my stop be? Let's you can see that it's pretty easy for us to put our stop right here above. That's our stop. If it breaks above that, we're wrong. Get out. Maybe 1% at most. Doesn't need to be a lot. What's my target? Well, I'm hoping it's going to break this level here, which means our next level down, I would say that's the first level. Maybe just under 400, around that level there. If we even got below that, my next level is down here below 380. Remember those levels. Now let's see what happens. It's all coming from what was prior. Momentum. Now you'll notice we got in here, then we waited 2 more days. Why did I wait 2 more days? This is the Heiken Ashi perspective. These first 2 were red, but they were red. They were red with bodies, with shadows on top. I'm waiting for this red candle with no upper shadow. That's the momentum candle. Just like we waited for the white candle with no lower shadow to give us momentum to the upside. Specific definition, right? A specific technical definition that moves us into the momentum stage. What does that mean? Well, go back to your stages of the trade, but what that means is we start to tighten stops. We start to look for where is our first level. Now, we're only 2 days into the trade. We're looking for at least 2 more before we would look to take profits. And then from there, when we take profits, we look to tighten stops. We look to trail stops. Am I looking to just let my winners run forever? This is a bearish trade in what was at the time a neutral market. If I get 4 to 6 days, 7 days, I'm going to be pretty happy in tightening my stops. Okay, so let's keep that in mind. Nearing completion. So we got into this trade back here. We got in here. This was when we started tightening the stop. We got 1, 2, 3, 4, 5 more days, big, strong days. And then all of a sudden, what did we get here? Oh, now I got both a turn on my stochastics and this inside candle. Would I sell everything? No, I would probably sell half, tighten my stop. Where would I put my stop? I would put my stop. Now, remember, I said I thought maybe we could get down. This was our first area right through here. That's the area we got to right through here. And we are at that point looking to close probably half around, I would say 405. 405 here. Remember, we first got this trade back here around 437. Right? 437. Moving the stops. You'll be able to see the reference points pretty easily. Remember, it's that first red candle, and it's when we first turned back out of this area and moved into this downward zone. What are we going to do with this? Well, we're going to look at what would have happened if we would have bought a put. What would have happened if we would have done a spread? Would I manually do this or use a trail stop? I manually trail. I don't do a lot of trail stops. If I'm going to do a trail stop, it's at the very, very end of a trade. But I'm going to be manually following this, setting alerts, and I would prefer to work my way out individually. Now, as we talk about nearing completion, let's go one step further. What happens next? Even more of an upside turn. Any doubt that was left is gone at this point, and that was the trade, right? What led to this trade? Negative momentum on the posture. Choosing a stock that had shown weakness, breaking a support level based on earnings, so it was reacting to the downside. A stock that was in a leading sector that was now starting to lead to the downside. That all was context leading up to this. And then we got the trade. And then we got the trade. Okay. Same questions. Doesn't matter whether we're bullish or bearish. What do we need to know? When are we going to relieve pressure and how much are we going to relieve? Is it after 2 days, 4 or 5 days, 7 days? How much? Well, all of that is going to be contextual by market posture. When do we tighten our stop and how much? These are all risk management questions. This is where a case study comes in. You'll notice you can get signals all the time. You'll get setups and signals. Setups and signals, setup and signals. Getting in's the easy part. Getting in's the easy part. How we get out, how we tighten stops, how we decide when to take profit, how much do we let run? Why are we doing it this way? We have very specific reasons and logic, right? Because we force the the professor to go to the computer every Sunday. Every Sunday. And we get that posture defined. And that posture is what creates the context for us that allows us to make better decisions without having to stop and think so much. Oh, should I do it this way or that? The context is there. We're just trying to make sure that the context translates. Should be part of the trading plan. Absolutely. Okay. Questions. They don't have to be about today's material, but if you have questions about anything we talked about today, let me know. I'm going to reference this to everybody else to go back and watch these case studies because these are going to be useful. Question came in and says, when you say take a third, does that mean you sell 1/3 of the position you have? Yes. If I had 10 shares, I'd sell 3 or 4. If I had 5 contracts, I'd sell 1 or 2. Right? Because that's 20 to 40%. Right? It's somewhere, I say around a quarter to a third. So around 25 to 33%, which could mean anywhere from 20 to 40%, depending on whether you have shares or have contracts versus when we were deep in the throes of October. If you remember, I had a bullish trade and I said, I'm taking half after 2 days. No questions asked. I followed that plan and then the market rallied. Okay. Do I wish I would have kept more? Sure, I do. I followed my plan and I wasn't regretful that I took half. I was thankful that I kept half. And having taken a half already, I had no problem just letting it run and run and run. And I got all of it. It would be harder to do if you hadn't done it that way. Took a plunge, bought a call on PLTR. Love it. Love that momentum. I agree 100%. Perfect. What else? Does that hopefully answer your question, Phil? If not, let me know. But the principle 100% is the same. Stocks break the position up into chunks where we scale out. We say, you know what? I'm going to take, if I bought 10 shares, which for a $400 stock, like SPY, that's $4,500, right? You buy 10 shares and you take half off. You say, all right, I booked X amount of profit. And then again, can you explain the volume versus implied volatility? It seems that most options on chains, implied volatility is always higher. Yeah, that's a good question. Let me pull up a chart, because if you look at SPY, it's not at all going to be like that. Remember that. So I've got volume and open interest here, and volume. So volume is how many contracts of that strike price. So let's just take the 456 calls. 2,073 traded today. We don't know if they were buy to open or sell to close or sell to open or buy to close. We could try to track that a little bit if we watched the open interest, and we could say, oh, the open interest increased 500 from yesterday to today. So that means that more were open, but we don't know if it was buy to open or sell to open. That's not important to us. What's important to us is, what does it mean? The volume in the open interest is building our understanding of liquidity and competition. How much liquidity and competition is there? And what we see in volume and open interest is going to directly correlate to what we see between the bid and the ask. 9,000 contracts traded today. 31,000 contracts are open. That's one strike price. There's literally several 100,000 contracts just sitting here, one strike price in 14 strikes. And again, the same over on the other side. But this is SPY. This is the most liquid stock in the world for options. What does that give us? It gives us these really teeny tiny 2 and 3 cent spreads. I came from PNC. Let me show you PNC as an alternative. PNC as an alternative is volume and open interest. Now my volume is 12, 23. My open interest is 357, 940, 257. What is I'm not getting 3 cent spreads. I'm getting 30 cent spreads. So the market makers aren't charging $3 a contract to trade this. They're charging $30 a contract to trade this. Way less efficient. Why? Because there's only 1 or 2 guys that are like, yeah, come on in. Come on into the party. And then they shut the door and they lock it. And you're like, oh shit, what have I done? Is there a ratio? Nah, I mean, I look more at the ratio of the spread differential. It's got to be less than 10%. So if I have a $2.40 option, it's got to be 24 cents or less. But realistically, I want single digits. I want 10 cent spreads or less. And most of the things that we look at, this is why I look for things that have 2 million shares a day and trade a lot, because things like Meta and Google and Apple and the NVIDIA, these things trade a lot of options, whereas these other things, they don't. And I don't want to trade them. So great question. Now, that volume and open interest all has to do with the efficiency and the depth of the market, right? How competitive, how easy are we going to get in or out? Option volatility, on the other hand, deals with pricing from a historical perspective, meaning are options cheap or expensive now relative to what they've been? So if I'm looking at Netflix, expensive is up here around 50. When it's up around 50, you're paying a ton. Cheap is down here around 25. We're at 32. So we're closer to cheap than not. So this would tell me, yeah, options are not terribly priced. I could be a buyer. If I go look at the volume and the open interest on Netflix, I would expect it to be pretty decent. You can see, right, we've got dozens and thousands. We don't have thousands and tens of thousands because not many things do. Dozens, hundreds, and then thousands. What does that give me? Well, this is a $12 option, so I would want it to be less than $1.20. Yeah, it's 25 cents. Well, 25 cents on a $12 option is like 2.5 cents on a $1.20 option. So I'm okay with that. That's pretty tight. I could live with those spreads right there. Absolutely. Hopefully that makes sense. Great question. This is what I mean, right? Like Thursday, come with these questions. We have up to 45 minutes longer if we need it to get these questions answered. And every foundations, I'm trying to leave at least 5 to 10 minutes for you guys to bring these questions. And everybody benefits. What else? Anything else before we wrap up our last formal Trading Foundations course? Oh, it was a blast. Now I'm going to go back. I'm going to make the slides a little prettier. I'm going to put some images in and I'm going to clean it up. There were some slides where I'm like, that didn't flow well. So next time will be even better, but we're not going to start again at the beginning until January 1st. Kelly Criterion. Okay, real quickly, Kelly Criterion. Yes, thank you for reminding me. I'm going to bring up a spreadsheet real fast. Kelly Criterion is not to be played with lightly. You need to have at least 50 trades. 50 trades with a stable expectancy before you try to use Kelly. I started typing up an explanation. I'm going to finish it and put it in there. But I just want to go in and show instead. So let me quickly bring up our spreadsheet so you'll see where this is coming from. We get our resources. We'll get an option log. Where is Kelly criterion coming from? It's coming from the dashboard. Remember that these two here, expectancy and Kelly, go hand in hand. Expectancy looks backwards and it says, based on everything I've done, how much do I expect to make per dollar at risk? That's what has to be. That's what has to be positive. Our expectancy has to be positive. If your expectancy is negative, you're a losing trader. Like, we've got to stop and figure it out. Don't take risk anymore is what it's telling you, because your Kelly will be negative. What Kelly does, Kelly takes what you've done and says, if you were to continue, that's why we need at least 50 trades of a stable expectancy, because we're relying on the fact that now our probabilities are going to stay somewhat consistent. Because if you optimize your risk and then something drops in your probabilities, you're going to lose more than you want to lose. Kelly is going to help you optimize your risk. That's its job in a nutshell. Kelly can help you identify what is the optimum level of risk for any given system based on how it's performed in the past. If it were to continue along that line going forward, that's a big assumption, but it does help us to pinpoint our risk. So the 50 helps us. Senator says, asked about the 50. The 50 helps make sure that we have statistical relevance. We don't want the law of small numbers to be like, hey, I have 10 trades and my Kelly says take a bunch of risk. 10 trades, not enough. That's not a statistically relevant number. We need more. Got to have more to say, yes, I trust this now. I trust the math. Jeffrey's telling me he likes this. I'm talking math and he's like, yes, sir, talk about the math. Yes, right? If the numbers make sense to us, it gives us that capacity to say, hey, you know what? Remember that our Kelly, first of all, we can shrink it a little bit. If I take 70% of maximum Kelly, so if my maximum Kelly is 20%, that's how much my portfolio heat would be. Instead of taking 20, I take 14. 14 is 70% of 20. If full Kelly makes a 50% return, I'm going to make 45. I get 90%. So I take 70% of the risk, but I get 90% of the benefits. That's thinking like a trader right there, right? So this is how we come to these risk. How do I determine my risk? Risk optimization. That's what Kelly's all about. Yeah, it's phenomenal. So I take Kelly, I multiply it by 0.7. That's my risk. I divide that by the number of trades. So if 14% is my number and I say I'm going to have 8 to 10 trades at any given time, well, I take 14 divided by 8 to 10. That tells me I should have about 1.5% risk per trade. Perfect. 1.5% risk up to 8 to 10 trades at any given time. Now I have my risk under control. That is a real-time application, and we have to be willing to make adjustments. Steven says, I am 4 trades away from completing my 100. Kelly is 55% over 96 trades. Magnificent. That is absolutely phenomenal. That's exactly that. That's what we're looking for. Now what? Now we go and we say, hey, can I actually make more money by taking more risk? Now, don't get greedy, because Kelly is the math, and the math is going to collide with the psychology. We can't just take more risk willy-nilly and think it's not going to have an implication. This trading system that we're working on is a very delicate ecosystem. You got to make changes slowly and gradually as not to disrupt what's already there. So yeah, congratulations, Stephen. Phenomenal. 55% Kelly over 96 trades. Absolutely amazing. Everybody else, I want to hear these things, man. This is the kind of thing that we want to work together as a trading tribe, share in each other's victories and understand that this is the way, this is the path of longevity, consistency, of doing the right things and never getting bored doing the right things. I love it, man. So happy to be a part of it. Okay. 17% in first 25. Love it. Love it. Oh, amazing. And now we're coming into a market that's a little easier to work with. Good things ahead of us. I got to wrap us up. Amazing. I took some extra of your minutes. I have a tendency to do that. I know. I know. Sometimes I just get to rambling about trading things. You know how it goes. Join me Thursday for Q&A. Nothing. I have no slides. I have no agenda. I have nothing but lightning round. Ask as many. Let's see how many questions and answers we can get done in that period of time. Let's make let's make 50 the challenge. I don't know, something like that. It's good to see everybody. Have an amazing night. Tomorrow morning, weekly check-in, 15 minutes before market opens. I'll see you guys there. As always, happy trading.